I spent nearly 20 years working with some of the world's leading banks and hedge funds in New York and London. So I know a thing or two about wealth, how to build it and how it can be destroyed. So what is the biggest financial mistake that most people make without realizing it? It's not lattes or avocado toast or the occasional getaway, it's their car. The one parked outside that is losing value every single day. Most people think of their car as a necessity or even worse, a trophy. I work hard, I deserve a nice car. I hear this all the time and I kind of get it. But here's the truth. Your car doesn't serve any purpose in a wealth building journey because it is fundamentally a depreciating asset. In this video, I'm going to show you how much your wealth your car is destroying. We'll break down the financing trap, the true cost of insurance and tax in Ireland, and the massive opportunity hiding behind your monthly payment. At the end, I'll give you a very simple rule to make sure your next car doesn't wreck your finances. So stick around because this may just change your financial future. So let's start looking at the numbers. According to AAA Ireland, the total cost of car ownership, including insurance, tax, maintenance, depreciation, is significantly misunderstood by most car owners. And depreciation, that is a silent killer. New cars lose between 15 and 20% of their value the moment you drive them off the showroom. So your brand new €40,000 Volkswagen Golf is now worth €32,000. That's $8,000 just gone. In 5 years, you've lost over 50%. It's like setting fire to your savings one slow mile at a time. Ireland's association with cars is changing. Back in 2015, Irish roads were dominated by affordable, reliable brands such as Volkswagen, Toyota, Ford. Diesel was king. Fast forward to today, hybrids and EVs are rising, and luxury brands like BMW, Audi, and Tesla have gone mainstream. According to the CSO, the average car price for a new car in Ireland has risen from €27,160 in 2025 to over €45,000 today. Why? Well, because of tech, more tech in cars, more financing options, and more desire for luxury. We're not just buying transport, we're buying identity, comfort, and status. And it's costing us. Insurance costs are on the rise again after several years of being flatlined. Motor tax is also changing. Since the WLTP emission testing was introduced in 2021, more vehicles are being pushed into higher tax bands, especially for the larger and less efficient ones. So, what's the bottom line? Cars are getting more expensive to own, to fuel, to insure, and to tax. And we're borrowing more to cover the difference. So let me give you a breakdown. Here's the full cost of owning a new €40,000 Volkswagen Golf in Ireland for year one. The financing repayments, whether it be HP or a PCP, will be around €1,000 per month. So that's €12,000 for the year. The fuel, based on an average of 17,000 kilometers per year at €1.80 per litre, that's around €1,800. The insurance will roughly be €1,000, motor tax around €200, and we'll say the servicing and maintenance around €600. So the subtotal before depreciation is €15,600. Now let's look at depreciation of about 20% and €40,000, and that is €8,000. The total cost for 1 year is €23,600. That's over €1,960 per month in just 1 year. In the next section, I'll show you how car finance makes this even worse and can keep people in the cycle of debt forever. So why do we keep going through this cycle? Why do we keep buying shiny, expensive cars again and again, even though we know that they're killing our wealth? Well, it comes down to psychology and a bit of ego. Okay, I work hard, I deserve a nice car, I need something reliable, oh, the repayment's only $300 a month, it's affordable. These all sound reasonable, but they ignore the big picture. The total cost, not just the monthly finance payment. Then there's a social pressure. Cars are status symbols, always have been. From the Ford Model T to the Tesla Model Y, cars have always said something about who we are. And let's be honest, when someone parks a brand new BMW next to your 10-year-old Honda Civic, you sometimes will wonder, oh, I wonder what they do for a living. Cars have become a billboard for success, even if bought on credit. I once had a client who was paying €250 per month in PCP. It seemed manageable until we added in fuel, insurance, tax, maintenance, and it came to over €11,000 per year. That is the trap. So let's talk about how most people pay for their cars. Debt. The first option we'll look at is PCP, a personal contract purchase. You pay a deposit and then you pay low monthly payments for a period of years. You don't actually own the car, but at the end you will have an option to make a balloon payment called a guaranteed minimum future value. If you want to keep the car, you have to pay this amount. Well, does that sound flexible? Well, let's now factor in that you will have mileage limits. You need to keep the car perfectly and you're not building up any equity in the car. So that's why most people just roll from one PCP into the next, starting the cycle all over again. The next is hire purchase, or HP. Higher monthly payments, but you do own the car at the end. No balloon payment, no mileage limits. Still, you're paying interest on a depreciating asset. And the third option is the regular personal car loan. You borrow the full amount of the car you own from day one. You can shop around with different lenders for better rates, but these rates are typically higher. So let's compare the cost of financing that €40,000 Volkswagen Golf. With PCP, the repayments will be around €1,000 per month with a 14,000 balloon payment. With HP, they'll be around 987 per month with no balloon payment, and a car payment will be around 1,080, around 9% APR. None of these are cheap, and your car is still losing value. And here's the kicker. Most people lose an average around 11% on a car per year for the first 5 years, with depreciation being as high as 20% in year 1. So after 10 years, your car is worth about 1/3 of what you paid for it. And people repeat this every 3 to 5 years. This is how loans are keeping people broke. And leasing, it may seem cheaper monthly, but you never own the car. It's the most expensive way to always have a car payment. Now let's talk about what all of this really costs you over time. So let's say you spend €8,000 a year on a car. That includes your loan, insurance, tax, and maintenance. What if instead of spending that, you invested it? Let's say you earn 7% return. After 10 years, you'd have around €110,000. After 25 years, you'd have €500,000. And after 40 years, you'd have over 1.2 million. That's not just a car payment, that's a house, a pension, a stress-free retirement. Your car could be costing you €1 million future. So how do you avoid this trap? How can you own a car without letting the car own you? You can use the 23-8 rule. It's 20% down payment, put money down up front, which will reduce your loan and reduce the interest. A maximum of 3-year loan term. If you need more than 3 years to afford the car, it's simply too expensive. And finally, 8% of your gross income is the maximum that you can spend on the total cost of the car, including loan, insurance, tax, and maintenance. So that 8% is of your gross monthly income. Now, let's look at an example. Say you purchased that Volkswagen Golf for €40,000. You put 20% down, that's €8,000, and you borrow the remaining 32. You spread it out over 3 years, and let's say your gross monthly income is €5,000 per month. So 8% of that would be €400. That is your total monthly budget for the car, including everything. So ask yourself, can you really afford this car? Or are you stretching too far? Look, if I could give you a tip here, it would be consider a used car. A 3 to 5-year-old car has already taken the depreciation hit. You save money up front and over time. That's how you can stay in control. That's how you can build wealth and still get to where you need to get to. Now let's look at some of the smarter options. If you live in a city, consider public transport. Car sharing services like GoCar or even cycling. You may not even need to own a car at all. If you're in a rural area, ownership may be essential. Okay, I understand that. Just stick to the 23-8 rule. Buy smart and hold on to the car long term. Drive it for 10 years, not just 3. Now, let's look at mindset. We need to reframe how we think about cars. Car is a tool, it is not a trophy. It's not a reflection of your worth or your success. True wealth isn't just about what you drive. It's about freedom. It's about flexibility. It's about options. So learn to delay gratification. Yes, buying a new car feels good, but that feeling fades fast. Financial freedom, that lasts a lifetime. Okay, so here's your challenge. Add up everything you spent on your car last year. Loan repayments, insurance, tax, fuel, repair, and multiply that number by 10. That's how much you'll spend over the next decade if you don't change. Is that number 80,000? Is it 100,000? Is it more? Now ask yourself, would you rather drive a new car every few years or retire 5 years early? Do you want to open up your own business? Buy that holiday home? If you're ready to take control, drop a comment below. So what is your biggest car expense regret? Let's help more people see through the shiny lies and start building real wealth instead of shiny cars. Thank you for watching, and don't forget to like and subscribe.